Alright everyone, get ready. We've just seen a huge and surprising turn in the US-China trade war. We said this might happen, that Besant would give in, but no one thought it would happen so quickly. The pause in the trade fight didn't come from smart planning. It came from panic. It showed up early, without warning, and it sent a loud message. The US is in trouble, and Trump is trying to stop the damage fast. This sudden change didn't look strong, it looked desperate. And when you really look at what happened, you'll see this wasn't a deal. It was the US backing down. China came into the talks with the upper hand. Yes, their exports to the US dropped by over 20%, but it didn't hurt them much because their total export income still went up by 8%. Why? Because the rest of the world kept buying from them. Global demand stayed strong, and the US threats didn't do much. Even more important, China doesn't rely on the US like it used to. Since 2008, the part of China's economy tied to US exports dropped from 8% of their GDP to less than 0.8%. That's a big change. China now has its own growing middle class and a wide range of other countries buying their products. Meanwhile, the US still depends a lot on cheap Chinese goods to keep prices low and inflation under control. If this trade war were a card game, China didn't just have good cards, they had the best hand possible. And Besant's tough talk? It didn't work. Trump kept changing his mind. Tariffs were 145%, then 80%, then 34%. It was confusing and made the US look weak. There was no clear plan. It looked like Trump was arguing with himself, not with China. In the end, the whole thing fell apart. And here's the biggest problem: inflation. China's inflation is close to zero. The US is at 2.4% and going up. That gives China more freedom to act. They can spend more money, cut interest rates, and boost their economy without hurting their currency. The US can't do that. If Besant tried to flood the economy with money, or force the Federal Reserve to lower rates, the dollar could crash, and the economy could suffer. Investors might even start losing trust in America's financial strength. So yes, the US gave in. The talks behind the scenes were probably one-sided. China didn't need the deal. They could walk away if they wanted to. And they acted like it. Now we have a pause. Not a deal. Not a solution. Just a short 90-day break. US tariffs on Chinese goods drop from 145% to 30%. China's tariffs on US goods go from 5% to 10%. A small step back. Just time to catch a breath before the next round. But don't be fooled. This isn't a win for Trump. It's a retreat that's being dressed up to look like a victory. Investors need to ignore the show and focus on what really happened. Let's look back. Trump started by putting a 10% tariff on Chinese goods. China didn't react right away. Months later, we're now at 30% US tariffs and 10% Chinese ones. So who really backed down first? Who took the bigger hit? Many people still don't get this part. US consumers and businesses are the ones paying the price, not China. The cost of imports for the US is 3 times higher than what China is facing. That means it's more expensive to make things in the US, and prices are going up for everyday people. Even with lower tariffs, it's still bad for the economy. And what each country trades matters. China exports high-tech products, phones, electronics, chips. The US couldn't afford to put tariffs on those, so they gave out a bunch of exceptions. But what does the US export? Raw goods, soybeans, corn, oil. Stuff that can easily be replaced. China can just buy from Brazil, Saudi Arabia, or Russia. No problem. And they're starting to pay for those things without using US dollars. That's a big shift that could hurt the US in the long run. So no, China didn't panic. Their economy didn't fall apart. They adjusted quietly and effectively. And now Besant gets to stand in front of the cameras and call this a win. He gets some praise, some headlines, a short moment in the spotlight. But it's all just for show. The numbers tell a different story. China's export income went up in April. The trade war barely touched them. And one more important point. It wasn't China running to the US for a meeting. It was the US rushing to set up talks in Switzerland. That tells you who had the power. And in the end, China agreed to pause some of their harshest actions, like limiting rare earth exports. That was their biggest weapon, and they didn't even need to use it. Just keeping it on the table was enough to get the US to back down. So here we are, a fragile pause, a quiet moment before the next fight. Nothing is truly fixed. But one thing has changed. The balance of power has clearly shifted. As we move into the next stage of this economic conflict, one thing is clear. This isn't just about tariffs anymore. It's a full-blown economic war, and in the first round, the US took a hit. China made a move that shook global markets by cutting off exports of 7 key minerals to the United States. These weren't random materials. They're essential for things like semiconductors, electric cars, airplanes, and even military equipment. By stopping that supply, China was basically saying, "We control the future costs of your most important industries." It was a smart and direct strike at the heart of American innovation. Prices shot up, supply chains stumbled, and the message was loud and clear. China still holds the keys to major parts of the global economy, and it's not afraid to use them. But now, almost silently, China has changed course. Those minerals are flowing again. No big announcements, no press releases, just a quiet shift. But that silence says a lot. Something happened behind closed doors. There was a deal, even if we weren't shown the details. The most likely part of that deal? The US agreed not to interfere with how China manages its currency. That means China now has more freedom to control the value of the yuan. They can lower it to boost exports or raise it to increase buying power inside the country. That's a big win for them. In global trade, controlling your currency is a powerful tool. And now China can use it however it wants. Markets reacted fast. US stocks rose, which was expected. But what surprised many was how much Chinese stocks jumped, up 3% in one day. That's not just noise. That's the market saying, China just came out ahead. Look deeper, and you'll see that Chinese markets are up over 16% this year. That's a strong rise, and it's not based on hope. It's based on real power and leverage. Investors believe China isn't just handling the negotiations, it's winning them. Meanwhile, those harsh 145% tariffs on Chinese goods have been cut down to 30%. That's still a lot, but it's more manageable. American companies can start buying from Chinese manufacturers again. Big names like Apple can keep making products in China without suffering huge costs. In simple terms, the push to separate from China, what people call decoupling, has been paused, maybe even reversed. The White House can try to spin it however it wants. Trump can call it a win in front of the cameras. But underneath it all, the US gave up more than it got. This wasn't a tie. It was a quiet step back. If we're giving grades, China gets an A-. The US? Maybe a C, but here's where things get worrisome. While the stock market looks good, the bond market is flashing warning signs. Interest rates on US government bonds are rising fast. The 2-year is near 4%. The 30-year is close to 4.9%. And the 10-year, which many see as a measure of long-term confidence, is pushing past 4.5%. That's not a good sign. Rising yields mean investors are selling off government bonds. They're doing that because they sense danger. When people move out of bonds, it's usually because they think the dollar will lose value fast, or because they expect inflation to stick around longer. Both are bad, and both could be happening now. Yes, a 30% tariff is easier to handle than 145%, but it still raises prices. It still keeps inflation going, from factories to shipping to the prices people pay. And while trade with China is open again, things aren't back to normal. Supply chains were badly damaged. Fixing them won't happen overnight. It'll take time to rebuild trust, shipping routes, and flow. And when imports finally come back, they'll come with a 30% price increase. That puts pressure on businesses. Some will try to hold the line. Others will raise prices. Profits will take a hit. Some companies might freeze growth or cut jobs. If that happens, the government may step in with subsidies just to keep key industries alive. At the same time, the Trump administration is promising tax breaks to global companies thinking about moving operations back to the US. That sounds good, but it adds to the deficit. More spending, less income, more borrowing, more government debt. And that's what's really scaring the bond market. It's not just about inflation anymore. It's about debt. A lot of new US debt is coming, and global investors are preparing for it. They're basically saying, we don't want to hold US debt in this situation. Instead, they're holding cash. Not gold, not property. Just plain dollars. That, in the short term, makes the dollar stronger. But it also shows a lack of long-term confidence. This gap between rising stock prices and nervous bond markets is dangerous. Both can't be right. One side will eventually lose, and when it happens, the break could be sharp and painful. On top of all this, the US still has no clear trade policy. One day it's high tariffs, the next day it's back to business. That back and forth makes it hard for companies to plan for the future. If you're a business thinking about moving a factory back to the US, you're asking one big question. Is this change real or just temporary? Because if the pause holds, what's the reason to move? China is open, cheaper, and stable again. Without a steady plan from Washington, manufacturers are stuck in limbo. And the longer that limbo lasts, the more likely they are to stay put, or even double down overseas. Let's be real, this wasn't a deal made from a position of strength. It was made under pressure. China pushed. The US gave ground. Now that the dust is settling, the world is watching to see who truly won. Was it Beijing, using quiet but powerful tactics? Or was it Washington, getting a short break at the cost of long-term control? You decide.